Okay, I think we are going to get rolling here. We are a few minutes past already, so don't want to hold up those that were here on time too much. So welcome everybody to Ulster Savings Homebuyer Workshop. Thank you very much for joining us. We know everybody's time is valuable, so we appreciate you spending some time with us to learn about home buying and the mortgage process. My name is David Friedman. I have been with the bank for about 8 years, but I've been in the business for about 30. So pretty much I've seen just about anything as far as a scenario goes. I'll never say I've seen it all, but I've seen pretty close to any type of thing you could throw out at us. So nothing's going to throw us off our game here. Okay. We do have a pretty good sized group. So I just want to go through a couple of basic ground rules with you folks. So one thing, if you are registered on, if you're logged on to the Zoom and you don't have your name on there, I would ask you to change it to your name. I know some people log in as it just says like iPhone or something like that. For tracking purposes, it'd be a lot better if you could just go ahead and put your name on there. If you have your name on there, then that's great. And then, sorry, just so that you know, as people join a little bit late, that's a manual process for me to let them on to the workshop. So I will get a little disjointed as I have to stop and let people in. So just bear with me for that. Okay. And so the way that these work the best is when they're interactive. Okay. One of the things I lost out on when COVID hit and we started doing these all virtually is that kind of face-to-face interaction. So I could tell if people were falling asleep or not, paying attention and all that. So what I do ask you to do is we'll stop a few times along the way, 4 or 5 times for questions and answers. We will also, if we have time remaining at the end, and as long as my voice holds out, we'll continue to do some at the end if there are additional questions. What we're going to do is use the chat function on Zoom in order to do that. So what I'd ask you to do is just go ahead and put your questions in the chat box. I have one of my associates, Mike Zioli, is on the line with us here tonight. He's going to be helping me with the chat and doing the Q&A when we do stop. What I ask you to do is just make sure that your questions are on the topic that we're on. If you have a question about something and we haven't covered the topic yet, I would ask you just to hold on for that because chances are we're going to hit those questions at some point. We're going to answer most of them just within the presentation. So if we're doing income and you have a question about your assets, like I said, just go ahead and write it down, but don't worry about putting it into the chat box until we get to the assets section. And then if we don't answer it there, you can go ahead and put it in. Okay. And we will do that, like I said, 4 or 5 times along the way here. I know we are set up for about 2 hours. It does generally take about that long. I'll apologize in advance. I know it seems like an inordinate amount of time, but there are just infinite things for us to go over. So we try to condense it down as much as we can, but it's all good, important information. Okay. So again, go ahead and use the chat box for your questions, and we should be able to get to most, if not all of them tonight. Okay. And I know you're all interested in getting your credit for the $750 closing costs credit. We will go through at the end of it how you go about getting that. Okay. So to start off with here tonight, I want to introduce, we have a special guest with us here. Her name is Carolyn Hurley. She works for Ulster Habitat for Humanity. She's one of the great groups that we work with hand in hand here at Ulster Savings Bank. And I'm going to give her a few moments to talk about what they do and how they can help you get into a home. Carolyn, welcome.
All right. Hi, everybody. Thank you. And thank you to David for allowing me to join in to share a little bit about Ulster County Habitat for Humanity. We believe that everyone deserves a safe, a simple, and affordable place to live. We are a nonprofit housing organization in Ulster County. What we do here in Ulster County is we do new construction. You may know that some other affiliates like Dutchess and a few other, if you do follow Ulster Habitat, you know that they do some rehabs. We do new construction. We do new construction currently of single family homes. Just to let you know, we're very excited, though we also are moving into other ways that we can help the community, hopefully in aging in place. And one of them is a rants program. So what do we hear? What do we do in Ulster Habitat? So we to kick off, we purchase the land, we build the home, and we sell the homes to qualified families with an affordable mortgage, equal around 30% of your overall income. And our program is based on a few criteria, as if you can see the slide. There's the need for housing. The need for housing could be that you're living in substandard living. You could be living with somebody else. You could be living in overcrowded. You could be living in an unsafe neighborhood. You could be living, I just said with somebody else, I'm sorry. Or it can be a financial need for housing. And that means that more than 30% of your overall income is going towards your rent. So we have more families since COVID actually have been qualifying under that financial need for housing. The other is the willing to work in partnership with us. And what that is what we call our volunteer sweat equity partnership hours. Depending upon the size of the family, there's hours that are to be completed. Some of them is on the build site. Some of them is taking a HUD certified first-time homebuyers education class. It's also taking some classes that we have put together with the help of the community. That will go over things like how to read your mortgage statement, how to understand your mortgage statement, your taxes, your tax escrow, how to budget now that you have this big payment. It also is building on the homes and other habitat activities. The whole goal of willingness to partner is when it comes to closing on your home, once we hand you over your keys, that we know that you have all the skills to be a successful homeowner. And honestly, that is one of the best parts of the program, because that I work with families from the very beginning of application or inquiries all the way to closing on their home, and then a little bit into post-purchase. Just a little bit into that, so we know that everybody understands everything. So there's the need for housing, the willingness to work in partnership, and the last one is the ability to repay an affordable mortgage. So to qualify for our home, you have to have steady income, an income that falls between 50 and 70% of the median area income for Ulster County. That number, that changes the minimum income amount and the maximum, the minimum being 50, the maximum being 70. Those numbers change depending on how many people will be living in the household. Additionally, those numbers change each year by HUD. We don't pull credit at this stage, but we do evaluate what's called reasonable debt. We want to make sure that we put you into a home that you can afford. You can go on to the next slide, David. Okay, as I move forward, just go a little bit more about our program and how to apply. I just always like to have a visual. Here's two of our recent builds. Both of these homes are actually in Saugerties. We just put our 8th home in a development in what's called Glasgow Ponds. I have 8 families. Very excited. The last one closed 2 days before Christmas. So it's very exciting. What you're looking at underneath, we're doing our first ever habitat development of 10 single family homes in Saugerties, not too far from actually where we've been building. It's about a couple miles. So our applications are currently open for 10 homes in the subdivision. We have 4 in our first application round is going to be 4. The first 4, when you come in from, I can't show you, but you come in from the top, it's the first 4 on the top that you're looking at. Additionally, we are actively looking, and I went on we call it a road trip, and we did look at some lots today. And so we are looking at lots, also additional lots in Saugerties, Port Ewan, and hopefully Kingston as well. So our application is currently open. It's not closed, and it's originally open for 4 homes. As we look actively for other homes, it may be a little bit more homes in this application round. And of course, as David may know, as we personally apply for grants too, so that number changes. But our applications are open right now. You can go on to the next slide. This is just a little roadmap. and maybe I'm going to read it along. So you're wondering a little bit about how does the process go. So our application cycle opens, which it did in the second week of January. I had a bunch of home buyer info sessions in January, February, and March. And then you request an application. At the last slide, there will be my email address and my contact information if you're interested in the application. Also, there's a web address too. So you can download an application, request an application. When you get the application, there's a cover sheet that goes into all the financial documents that you need to return with your completed application. So you complete the application fully, you make copies of all necessary financial documents that are to you. At this point, I'm just going to stop really quickly. What we look for qualifying income before I go any further. We look at, of course, your wages earned. If anybody's getting SSI or SSD in the house, we look at that as income. We look at SSI, SSD, dependent care, foster care, child support, alimony. So we look at these as income coming into the home to qualify. If you're a veteran, VA, any VA benefits that you may receive as well too. So that is what we look to qualify for income into our homes. So there's a whole list to see what you should return for you. You submit your applications. I'm up to number 5. You submit your application with all necessary financial documents by the application deadline date. Currently, it's open. We haven't advertised the close date yet. And then once an application is complete, I 30-day review of your completed application. After the year application, so what I'm at this point, what I am doing is I am looking to see need for housing, willingness to partner, and ability to pay that under the preliminary criteria. If that is met, then you schedule an appointment with me and we discuss what type of affordable option, mortgage or financial institutions available for you to apply for what's called a pre-qualification of a mortgage. And if you're able, that's when your credit will be pulled. It's the financial institutions will pull your credit. If you do get if you do get a pre-qualification, you come in and see me, and we take the next steps to assess needs and willingness to work in partnership. And then your application is put together and sent to our board and for final review, and they make the final decision. And when they come back, if you're in the program, you are in the program. It takes you're immediately in the program. You start working on your sweat equity, and which is partnering with us. And it can take anywhere from 9 to 12 months, and 8 to 12 to 18 months till you're in your home. It all depends on construction schedules and how you're working through your sweat equity. Okay. Any question? Well, I don't know how you want to do the questions, David.
So let me throw up the next screen.
Yeah.
Has all your contact info and
Yes.
everything, right? So let's do that.
Mhm.
Okay, and then let me take a look in the chat box.
I want to make sure I did take some notes. I want to make sure that I actually did touch everything.
Okay. So yeah, somebody asked, does pulling credit affect your score? When you apply for your pre-qualification from your lender, they're going to have to pull your credit. Certainly, I'm sorry, does Habitat pull their own credit report as well? No,
I
not at all.
can in
So
New York State.
yeah, so I didn't think so. I didn't think so. I just wanted to double check on that before I said the wrong thing. So yeah, so Habitat's not going to do that at all, but they do have you get pre-qualified by a local bank, such as Ulster Savings Bank, and in order to do it. Habitat doesn't provide the financing itself. They provide the home and some grant assistance, but the financing is going to be done through us, one of the local banks.
Right. So, and there's all my contact information up there as well. I also wanted to say at the part where if you don't meet criteria, I just want to touch on that really quickly. If you don't meet criteria, when I evaluate an application, all applicants, I contact and all applicants to go over the reasons why, whether your income, you not steady, whatever the reason was, okay? Because if you feel that you may meet criteria in the future, you are more than welcome to apply again. And I do get a lot of repeat applicants, and I have gotten repeat applicants who then have actually then been accepted into our program. Additionally, we do have this program. It's called Homeward Bound. And what that is, if you apply, and it's usually typically something like your credit's not there yet. You meet all other criteria, but maybe you need to work on your credit a little bit. It's an invite only into this program, and that puts you into we call it a Homeward Bound, where you will connect with a credit counselor, and then you would work on your credit, become mortgage ready. And then once that is, again, and I continue through this whole process to be in contact, that then when they become mortgage ready, then we circle back into the application. So it's a fantastic way to be able to help people get into their homes, even if that not at that time, but there's an opportunity in the future. So we're trying to work with the community more to help the community become mortgage ready.
Right. Well, I thank you very much, Carolyn. So what we'll do is, if you do have any questions for Carolyn, you got her contact information is there on the screen. If you think of something later on during this program that we're doing, you can put it into the chat room. I will answer it to the best of my ability. If I can't, I will put you in touch with Carolyn, or I'll get in touch with Carolyn and ask her and get back to you. So we'll definitely make sure everybody knows what's going on at all times. No issues there.
I want to thank everybody. I did see one question that popped up real quick. And there is a Columbia Green. It's actually now expanded. It's Columbia Green Habitat for Humanity. And I believe their applications just opened. So they're accepting applications for a couple homes right now too.
Oh, okay. Excellent.
I saw that come right up.
Yeah, no,
okay.
That's fine. Yeah, and then the other question that's in there about some money saving advice for buying a home for a cash buyer. Yeah, we're going to get into assets and everything during the program, so we'll cover that. Okay.
All right. Well, wonderful. Thank you very much. And I'm available. There's my contact information. Feel free to give me a call, send me an email, and I'd be happy to speak with anyone. And I want to thank David and Ulster Savings Bank for this opportunity. I appreciate it very much.
Very welcome.
You guys have a wonderful evening.
Yeah, thank you. Talk to you soon, Carolyn.
Bye.
All right. So let's get into our meat and potatoes here. So real quick, I just want to go through a little bit about Ulster Savings itself. I'm saying we've been in business for 170 years. We have the 15 branch locations and 2 lending offices, all in the Hudson Valley. We can lend anywhere in New York State except for the 5 boroughs. Okay, we do not do anything in New York City. There's different sets of rules, laws, and fees that go along with those. So we don't lend in the boroughs, but we can do anywhere else in New York, including Long Island. We actually used to have a branch down Long Island, so we've done quite a bit down there. Upstate, no problem on any of that. Our mortgage operations is centered right here in Kingston. Our headquarters is on Schwank Drive. We have offices, bank branch offices in Ulster, Dutchess, and Orange counties. And we are a full service community bank, as you see with the banner going across the top. We have, in addition to obviously mortgage lending, we also do all your regular everyday banking needs. We have an investment arm with financial advisors. We do have tax and payroll services here, where we can do everybody's favorite topic, your income taxes. We can help you with payroll if you have a smaller company and you want to do payroll services. We do that here. And we have a full service insurance arm as well. For everything from auto, home, life insurance, all that fun stuff. So we do believe in supporting the communities that we're in. So you see at the bottom, in the last 25 years, we've donated over $15 million and thousands of man hours to local charities. Okay. So now we're going to get into the real guts of the presentation here. So we talk about what we're going to talk about here tonight. So about the 4 C's of mortgage lending: capital, capacity, credit, and collateral. We're going to get into each one of these in great detail. Okay, so we'll start off with our first C, capital. So this is the money that you need in order to close on your loan. Okay, so this is talking about you find the house that you love and you're going to go buy it. How much money do you need in order to do it? So we talk about down payment, closing costs, escrow, and reserves. So down payment, how much of a down payment do you need? Well, my favorite answer to all my team's questions, their worst answer that I ever give, it depends. Okay. Everybody's situation is a little different. You're going to hear me talk about things like this all throughout the presentation. So everybody's situation being a little different. You need to get a custom quote that works for you. Okay. We get clients in all the time and say, oh, so-and-so, my father, my uncle, my mother, whatever, told me I should get an FHA loan, or I should get this kind of loan, or make sure I don't get this kind of loan, or what have you. Listen, everybody's situation is a little different. When my parents bought a house, obviously things were wildly different than they were when I bought my first house, which is wildly different than things are today. All right. So we do a lot of work to make sure that we stay on top of the latest and greatest things that are in the mortgage world. And I invite you to take advantage of our expertise with that. So when it comes to down payment, how much you're going to need, it depends. We have programs that you need to put as little as 5% down, as little as 3.5% down, as little as 3% down. And we do have programs where we can do 100% financing of the purchase price. Okay. Now, not everybody's going to qualify for all of those programs. So some programs have income limitations, somewhat similar to what Carolyn was talking about with the Habitat programs, where there is income limits on how much money you can make in order to qualify for the programs. Most of those high loan to value programs where you're taking out a large loan compared to the value of the house, again, you're 3% down or doing 100% financing. Not only are there income limits, sometimes there are asset limits, there could be geographical limitations on it. So please don't just take the little bits of what I'm talking about here and just expand out and think that anybody can get it. It also, almost across the board, those have to be first-time home buyers in order to do that as well, okay? If you own a home now, you're going to sell it and you're going to buy a new one. You're probably not going to qualify for those, but don't get discouraged. We have a ton of programs here, and we can usually find something that'll suit for everybody. Sometimes it's not today, but we can set you up on a path so that down the road, in the near future, you might be able to qualify for some programs. Just because I just touched on it, I want to go off on a little bit of a side on here. When I talk about first-time home buyers, there are different loan programs have different definitions for what a first-time home buyer is. Sometimes it's just what it means. You've never owned a home before. Okay, now you're a first-time home buyer. It could be that you used to own a home, but if it was more than 3 years ago since you owned a home, you sold it, you rented for the last 3.5 years, for some programs, you will be considered a first-time home buyer again. Okay, so again, as I get into them, we're going to talk a lot about those types of programs here tonight. So don't be, like I said, totally discouraged. If you're just in a situation where, again, you already own a home, you're buying a second home, you're buying an investment property, or you're selling a home and buying a new one, again, most of those types of what I'll call kind of special programs don't necessarily fit for you, but again, we have plenty of other programs to look into. So how much do you need on down payment? It definitely depends on what your current situation is. All right. When I talk about 100% of the sales price, I mean it, but that doesn't mean you can get into it with no money, because next topics that you see on here are closing costs. Okay. Every loan has closing costs. All right. Some loans have more than others, depending on some of the fees. Some programs have higher fees than others. So how much do I need to set aside for closing costs? It depends. Different programs will have different things. Geographically, that will depend as well. Our two largest expenses are what's called title insurance, which is just New York State. It's a state mandated fee. It's all electronic now, but I'm old. Back when I started doing this, there was just charts that we looked at, and if your sales price was this, your title insurance was that. It just went right off of what the sales price and what the loan amount were. So that's a state mandated fee. It'll be the same anywhere you go. The other of the two big closing costs we generally have is a mortgage tax. We live in New York. In case you didn't know, New York loves its taxes. So there are about 6 states in the country that have a mortgage tax. Yay, New York is one of them. So we deal with it because this is where we chose to live for whatever reason. So, so those two things, again, that's going to be a state mandated fee. Any bank that you go to, obviously it's going to be the same. We don't have that much influence over Albany and what they charge you on stuff, but it does depend on where you're buying. Different counties will have different costs on that. So generally speaking, as you move further up the state, it gets a little cheaper. So Long Island is more expensive. than Putnam County. Westchester's more expensive than Putnam County. Putnam County is more expensive than Dutchess County, and on up. So once we get above Dutchess and you start getting into Columbia and Greene, that's where it starts to level off some. But so that will depend on, so the same house for the same cost in the different counties is going to cost you more or less, depending, mostly because of that mortgage tax. Okay, so how much do you need? I don't like to throw too much out there, but you are generally looking at somewhere around 3 to 5% of your purchase price if you want to be safe. But your best course of action is to talk to one of my loan specialists, speak with them, run through a custom quote so they can tell you exactly what you'd be looking at with this purchase price and this loan amount in this county. Okay. In addition to county, we also have several of our towns and cities in the area that have extra taxes built into them as well. They call it preservation tax, something like that. And these, unfortunately, have gotten a little bit worse in the last year or two. So not trying to scare everybody, just being realistic here. Okay. The next topic you see on there, it's called escrow. So this is a term that comes to mean multiple different things in this world. It's a term that can be used multiple different ways. If you hear escrow on like a TV show or a movie or something, basically that means you're closing. They'll say we're going to escrow, then that means that you're essentially going to closing to sign on your documents. That's not how it's used in our area of the country. In our area, it's typically set up for taxes and insurance, property taxes, and homeowners insurance for the home you're looking to buy. So you may need to put money into escrow at the closing to start that up. Okay. And again, how much you're going to need, it definitely depends on the house because it goes off of your taxes and insurance. And then it also depends on what time of year that you're buying. Okay. Our property taxes in most of the areas that we work in the Hudson Valley, we're looking at, we have a school tax bill that's due September, October, and we have a town tax bill that's due January or February. So throughout the year, depending on how close you are to those dates, can affect how much you have to put into that escrow account. Okay. Not everybody needs to start up an escrow account. It is something just personally, I recommend. The bank doesn't make any money on it. There's no service charges or setup fees or anything like that. If the taxes are $6,000 a year, it's $500 a month that has to go into your escrow account. There's no markups on it at all. It's just it's an easier way to budget. So you can look at your house payment as all one lump sum instead of, okay, I got to pay this over here and this over here and this over here. So especially for your first time home buyers that aren't used to having those costs, I really, really recommend that you do the escrow, and some of the programs require it. So there's that. The last topic that you see on there is reserves. Okay. So reserves just means, what do you have left over? You go through the process, you found the home of your dreams, you go through the process, you're sitting at the table, you sign 100 different pages. Sorry to break that to you. Sign 100 different pages for your mortgage and the purchase and all that. What do you have left over in your bank account after those keys get slid across the desk to you? Okay. That is what reserves is. How much do you need? Anybody want to guess? It depends. Depends on your program. It depends on what type of house you're buying. If you're buying a single family house versus if you're a multifamily house. If you're buying a house with some rental income, the reserve requirement is generally a little higher, but then again, it also goes off the program that you select. So just be aware of that. And that's where, again, I know I'm repeating myself, but I believe really, really strongly in this. Custom quote, right? You don't want to go off of what somebody else just said. Hey, I just closed on my house. Here's what it was. You can get a good idea of the process, but that doesn't mean that they're in the same situation that you're in. Doesn't mean that you have the same credit scores. You're buying the same type of house in the same exact area and all that. Okay. So you want to work with one of our mortgage specialists, get a custom quote, and now you really know what you're looking at. Okay. Okay, so where does all this money come from? That's the next good question. Simple. First off, personal funds. That's your bank accounts. That's your checking, savings, money markets, CDs, that kind of stuff. This also includes things like if you have stocks over the last couple of weeks, maybe not a great idea, but hey, if you have stocks, you have mutual funds, you have a 401k, and you can pull funds out of that, great. That's all your personal funds. That's yours. The next thing you see on there is gifts. So gifts are perfectly legal. They're used all the time. It does, depending on the program, it is limited who can give you a gift. Generally, it has to be a family member. Okay, now not necessarily by blood. It could be by marriage. It could be somebody, your Uncle Charlie or what have you. You know, there's some leeway that we have there with that. But so it generally has to be from a family member. Sometimes it could be an employer. Sometimes it could be from a community group, a church, like a church group that you belong to. But different programs have different requirements on that. If when you're speaking to your loan officer and you're planning on getting a gift from somebody, just mention it right up front. Be open and honest early on with the process. It's not going to kill your deal, but it may make us go in a direction where maybe we can't use that with this program, but we can use it with that program. Okay. We don't want to set anybody up to fail. So the more open and honest you are with us up front, the better your process and the smoother things are going to be for you to get into your house. Okay. So that's if you're using a gift. The next one on here is seller concession, a little more complicated, but again, perfectly acceptable, used all the time. Basically, the seller can pay some of your closing costs for you. Okay, there's a way to work that out that the seller can actually, so if you qualify for your loan, you have enough income for it and everything, but you're just a little bit cash short, you might be able to set up something with the seller where they do what we call a seller's concession towards closing costs. So an example of that would be, say you're going to get a $5,000 concession to go towards closing costs. You agree in your negotiation with the seller, you're going to pay $250,000 for the house. Everybody's happy with that. Okay. So instead we make the sales price $255 with a $5,000 concession, where out of the proceeds of them selling the home, $5,000 will go towards your closing costs. Now it's built into the sales price, so it's not really costing them any extra money. And from your perspective, it's costing you a little bit more because you're probably financing a little bit more, but it gets you into the home. Okay. So it's perfectly legal. It's done all the time. What's the downside is the seller has to agree to it. Okay. It's not something everybody's going to want to do for whatever reason. Even if there's no logic behind it, it could just be like, nope, we don't want to do that. Okay, fine. They're not required to. The other thing is the house has to appraise out. So you agreed on a price of $250. Now we're going to make the sales price $255 with the concession. If the appraisal doesn't come out at $255, then we've got to rework those numbers a little. Okay, so that's basically it. But like I said, it's a regular occurrence, not just in this area. Like I said, I've worked for the bank for 8 years. But I've worked for other larger banks where I did nationwide lending. It's something that's acceptable pretty much all over the country. So that's another option where these funds can come from. The next one you see is nonprofit grants or DPAL. DPAL, you don't have to write any of this down. DPAL stands for Down Payment Assistance Loan. We have some programs where they might have that built in. So you're going to take out a first mortgage and we're going to do a DPAL. So say your first mortgage might be 97% of the price, and we're going to do a 3% DPAL, down payment assistance loan, for the rest. So that gives you essentially 100% financing. Again, there's certain programs that allow that. Most programs don't, but we do have some programs where it's there. What happens is generally there's a increase in the interest rate in order to do that. So if the going rate is 6.5, then that might make the rate 6.875. Well, why would I do that to get the higher rate? Well, it depends on what your priorities are. If your priorities are that your income is fine, but you're short on assets, that might be a good way for you to go. All right. And is it good or bad? It's neither. It's situational. So what's good for one person and might make sense for one, but not make sense for somebody else. So we just there's no magic here. We just do the math. We give you the numbers and you decide on which way that you want to or need to go as far as that goes. So nonprofit grants. So we work with multiple housing agencies in the area. Primarily in this area, we deal with Hudson River Housing in Dutchess County. There's another agency called oh boy, I always screw this up. CHI, Community Housing Innovations. They're both in Dutchess County. Agency called RUPCO, which is primarily in Ulster County. They do a little bit in Orange County as well, but they're primarily Ulster County. And then agency called Pathstone that is primarily in Orange County. And we work hand in hand with these housing agencies. They have different grants that they have available at different times. That is something we do not necessarily keep up with all the time because they change very fast, where they can announce they have a program and here's a grant. It's a $20,000 grant to help with down payment. And that might be here today. And in 3 weeks, it might be gone because the funding was exhausted. Okay. So that's something we refer you to housing agencies to check in with them. And that's almost entirely geographic. where they may want to, if it's Columbia Green, we're going to direct you to an agency up in that area. If it's in Dutchess County, we're going to direct you there and see what they have available at different times. And like I said, they could not have something available today, and in 2 weeks they could have something available. So that's something I encourage everybody to look into. Again, those are generally income derived. So, if you're over their income limit, there may not be anything available. And also first time home buyer requirement on a lot of those. Okay. The next one you see on there is our Homebuyer Dream Program. This is a grant that we provide through a New York State agency. This is something we've had for, I'm going to say it's about 5 years now. And the program has changed a little bit through the years. But basically in the beginning of the year, we get an allotment from this agency, and we are able to give out a handful of Homebuyer Dream Program grants. This year it was up to $30,000 in assistance that could go towards down payment and closing costs. It's a great program. That is not a loan. That is a true grant with no repayment on it. There are restrictions, income limits, and things like that. But that's something it's a great program we've had. We have exhausted those funds for this year as of right now. But what happens every year is, so this is something I think pretty much any mortgage bank can apply to be part of this program. And what happens is you're issued an allotment of them. Any funds that aren't used by the end of August from each individual bank go back into a pool, and they're redistributed to the member banks that did use all of their allotments. Every year we use all of our allotments, and we're issued additional ones. So right now we've used all of ours up for this year already. But really, it'll be probably around the second week in September, we'll find out how many more slots that we get, and those we have to use by the end of the year. So if you're taking this presentation and you're looking at maybe 6 months from now being ready to buy a home or whatnot, you might be in a position to take advantage of that program, which, it's like I said, it's fantastic. You're going to want to talk to your loan officer about that as well. The last option that you see in there is called the Smart Move New York Loan. This is another program that I'm really, really proud that Ulster Savings is part of. It is, I won't say it's exclusive for us, but there's only, I believe, 5 banks in all of New York State that can offer this, and we're really the only ones in our area that do. So what it is, it allows for a loan to give you up to 25% of the sales price it basically goes in as a second mortgage. What makes it unique is it's done at a 3% fixed rate. Okay. So if you're familiar at all with where rates are right now, which is not horrible, but not the best. Okay. I know some of you think it's horrible, but I'm old. I've been around where the going rates were in the 9s and 10s. So just kind of keep that in mind. We're not there yet. Hopefully we won't get back to there, but so if we can get you in with 25% of your purchase price at 3%, obviously that's going to lower your total debt quite a bit and make it a little bit easier to qualify for your house, or even make you qualify for a little bit bigger house because that payment is a little bit lower. Okay. There are restrictions on that. Again, first time home buyer, there's income restrictions depending on what county that you live in. So your best bet, if that's something that you're interested in, when you're talking to your loan officer or your mortgage specialist, go ahead and mention we talked about the Smart Move New York loan, and they can look it up and see if it's something that you qualify for. That is something that I can't say it'll last forever, but it does seem to be an evergreen program. That program has never run out of funds. We've had that, I'm going to say 4 years now. It's been in existence much longer than that. We've been on board with it for about 4 years. It's never run out of funds. So hopefully that continues to go on like that. Okay. With that, I am going to take a quick break as I turn over to my partner here, Mike. Ask to see if we have any questions in the chat box. I know we just finished talking, so I'll give you guys a moment here, but please don't be shy. As I said in the beginning, if you have a question about something, almost guarantees somebody else on the call has the same question. We get the same types of questions throughout as we do these presentations throughout the year, so don't be shy about that. Go ahead and hit us with whatever you got. Mike, we got anything there yet?
Nothing new, Dave.
Nothing new. All right, guys, listen, I got to make sure that you're staying awake. All right. I want you guys to do good on the test at the end so that you can get your certificate. Oh, I think we might have something. There we go. That's what we're looking for. What do we got?
Which are really the same thing, Dave. Can you use multiple programs together?
You want to guess what my answer is going to be? It depends. Okay. Some programs do work together. Some don't play nicely together. Okay. For instance, the program we have, I talked about that DPAL, that down payment assistance loan, that if you're getting that, you can get other grants, but we can't do that down payment assistance loan with the Smart Move New York program. They don't work well together. We can use multiple nonprofit grants. So if you got a grant from one agency and a grant from another agency, generally there's no issue with combining those and lowering your obligation even more. So a lot of those things can do. You can have personal funds, gifts, seller concession, grants on the same program. Absolutely. When it comes to the actual grant programs and things like that, sometimes we can combine them, sometimes we can't. Okay. And when we work, just to further expound on that, when we work with an agency like Habitat for Humanity, they will generally be providing their own grants for things. I've seen things where they've had houses, because again, they're building brand new houses. So if you've been looking around at houses, well, you're not finding a house for a good brand new house for 175,000, 200,000, anywhere in that range. But so the house might be worth 500,000, but with grants, it brings it down where your cost might be down around 300,000, 250, something like that. Now they already have grants on it. We can generally, if we have the Homebuyer Dream program available, we can generally use that in conjunction with what they're doing, things like that. So yeah, so it does depend, but there's a lot of times where we can piggyback these things.
Okay, we have a couple more.
Oh.
For a seller concession, what is the incentive for the seller?
The incentive to the seller is they get to sell the house. So, depending on the market, they may or may not be interested in that. If it's a buyer's market and they're getting 10 or, the house goes on the market and they get 10 or 12 people coming in, looking and putting in offers, they may be a little less likely to go along with that. But if it's a house that's been on the market for a little while, it's a way for them to help move the house along. Like I said, it doesn't really cost them anything. Ultimately, it doesn't cost them much of anything. There is, in addition to the mortgage tax, just full disclosure, in addition to the mortgage tax, there is it's essentially a sales tax that the seller pays in New York State. Because again, we're in New York, we love the taxes. So there is a tax that the seller has to pay on that. So their sales tax will go up a little bit. But usually what happens is within the contract, they'll say that it's the buyer's responsibility to pay the difference between the base tax and then the extra tax because of the concession. And quite frankly, if we're talking about an extra $3,000, $5,000, you're not talking about much of anything on the extra taxes there. Okay. I don't know, Mike, unless you could think of anything else in there, but that's, to me, it's really just about being able to move a house that maybe wasn't moving.
For the seller concession, would you work that out before you officially apply for the mortgage?
So generally speaking, you're going to want to be pre-qualified in the order of operations of things. You're going to want to get pre-qualified by your mortgage lender before you go out and put in an offer. Most realtors are not going to accept an offer unless you have a pre-qualification certificate. I was going to say in hand, but of course, almost everything's just digital these days. So, on your phone, I guess. So yeah, so you would get pre-qualified if that's something where, like I said, income-wise, credit-wise, you can qualify for this, but you're just a little short on funds. It's something we would say, hey, so you're about $3,000 short. When you put in an offer, just make sure you're asking about a seller's concession. So it's not, like I said, it's not necessarily within the mortgage application. We do have to approve the concession. There's limits on it. They can't give you $50,000, right? Depending on how much of a down payment you're making, that may limit the concession. The generally accepted number is 3% of the sales price. Excuse me. So on a $300,000 purchase, you're talking about $9,000 going towards your closing costs. So it can be a significant chunk. So yeah, just when you're looking to do it. So generally what happens is you put in an offer, you get an accepted offer, the contract's not drawn up that day. Now the attorney has got to get involved to draw up the contract. So in the meantime, you're going to want to reach out to your mortgage specialist, let them know that this is something that you're doing, and then they can give you advice. Okay, well, I see here, you're telling me you're going to get a $20,000 seller's concession. There's no way that's going to fly. That's over the limits. So here's the max that you can do, and now you can work that out with the sales price and whatnot. Okay, I hope that explains that.
aside from grants, what other financial factors would be most crucial in order to increase the amount that you can purchase?
Well, I mean that you're just talking about in general what your qualifications are for the home. You know, we have to make sure it's affordable from a monthly payment standpoint. And then in terms of, you know, once we can get you approved, there's no better approval. Okay. It's not like, well, I can get you this approval, but if you put down more money, I can get you a stronger approval. That doesn't really, there's really nothing like that. So it's really just a matter of what you need, what you want to put down. Again, we generally look at these things from an aspect of what do you need to put down, or how much do you need to have available. But there's also wants. So you might have whatever your, you know, great Aunt Sally passed away and left you a chunk of money. So you've got $50,000 sitting there. So I have $50,000 I can put into it. So you could not need to get a 3% down payment program, but maybe you want to hold on to that money because you want to do improvements, you want to go to Vegas, whatever you want to do. So, you know, that's just all part of the whole picture. That's not a direct question that I can answer in a general form like this.
The next one has to do with credit, which I know you're going to get to later.
Yeah, let's get to that later. Yeah,
Okay.
please. And then, yeah, let's just take one more for now, and then we'll move on to the next topic if there's another good one out there.
If I was pre-qualified, but not for as much as I would like, how do I make the pre-qualification amount go up?
So that's generally going to be from the debt standpoint of things, your debt to income and how much we can qualify you there. You know, your mortgage specialist will work with you in terms of here's what you qualify for today. Here's some ideas on how you might qualify for more. It might be a different program. It could be getting a cosigner. It could be there could be all different types of factors that go into it. Again, that's a very, very individualized type of question. So that's something I would suggest we would hold off on that and talk to your loan officer, because looking at each individual piece of this puzzle that we're putting together can be misleading. We really need to look at everything as a whole. Okay. So with that, I think we're gonna move on to the next topic. And like I said, at the end, if you still have additional questions, we'll jump back in there. Thanks for your help on that, Mike. And let's go on to our second C, capacity. How are we going to pay for this lovely new home that we're moving into, right? So we're looking at multiple different factors here. What's your current income? What is the history and stability of your income? And where is that income coming from? So how much, how long you've had it for, and what are the sources of that income? So a lot of different topics to go over here. So we are going to look at your current income. So for those of you that are W-2'd and salaried, and I always just use teachers as an example, very easy. Right on almost all the teachers' pay stub, it'll tell us what your annual compensation is. We take that number divided by 12. That's what we're using for income, okay? Then we get into other things that can be a little more complicated. You're an hourly employee, but your hours fluctuate. You work 36 hours one week, 38 hours another week, 42 hours the next week, whatever. So now we got to look at, this is where history and stability comes into play. Same thing if you're commissioned or you get bonuses or any type of overrides or anything like that you're getting, okay? Those are things we're going to look at over a longer period of time. I don't want to qualify somebody, if somebody's a salesperson and they just had the best month ever, I don't want to qualify them off of that month because we don't know what the next month holds or the month after that or 6 months from now, right? So we're going to kind of average that out over a period of time. That might be over 1 year, might be over 2 years. 2 years plus year to date would be kind of the old standard in the business. We don't always have to go back that far, but a lot of times we do. So depending on what your sources of income are, that's where it is. It's where when somebody says to me, well, this is how much I make, I have to ask follow-up questions because that doesn't really tell me everything. Is that how much you made right now, but you made totally different income last month and the month before that and the month before that? Or like I said, are you salaried and you make the same amount every month? That's great. None of this is good or bad necessarily. It's just situational. We have to get into the details, into the real meat of how you're paid on that. Do you have self-employment? Okay, there's another big thing. Anybody that's self-employed, obviously great time this week to have this conversation because hopefully you just filed or you filed your extension, okay? So we're going to look at not just 2024's tax return, but we're going to look at generally a 2-year history because, again, we don't want to qualify you just off of the best that you've ever done. So if we qualify, we could look at 2023 and 2024. How much are we going to use off your tax return? It depends, right? It's not generally going to be the top line number, but it's also not generally going to be the bottom line number. It's going to be somewhere in between. There's a whole process that we go through. There's a chart that we go off of, and we're going to add back in for this and take out for that and whatnot. And we're going to come up with your qualifying income. That's something that is not, it's not necessarily super difficult, but it is a little bit of a process. It's part of the process. Okay. So we want to do that. That's where the history and the stability comes in. What if I'm just starting a new job next week? Well, it depends. Is your new job salaried? Great. We can use it and just run with that. If your new job, if your old job was salary and you're moving into a new job where it's a salary, a smaller salary, but then you're commissioned, guess what? That might be a bit of a hurdle for us to get over because we don't have any history of that commission. You know, or hey, I'm going to get this huge bonus at the end of the year. Well, most bonuses are based off of performance. How do we know how you're going to perform for the rest of the year? So can we use that bonus as part of your income? It depends. If you've gotten it for 2 years and it's likely going to continue, then we can generally use it. But again, we're going to average it out over a period of time to make sure we don't want to set anybody up to fail, right? We don't want to set you up where we're just taking the best month that you've ever had and using that to qualify. Conversely, we're not just going to take your worst month either. It's going to be somewhere in between. You work at a type of job where there's some seasonal differences, okay? You're busier over the winter than you are over the summer. Or, I mean, the easier one is like a landscaper, obviously much busier over the summer than you are, or pool installer, much busier over the summer than over the winter. So if we had to qualify right now, your year to date probably isn't looking real great, but we can look at the last 2 years and we know obviously come June, July, August, September, those numbers are going to go up. Well, now we can average it out over those periods. So we do everything we can to try to be as fair as possible while following all the guidelines that we're hitting. And don't kid yourself, we are regulated to death in this business, okay? We have been ever since really 2008, 2009, when the big mortgage crash happened. For those of you that are old like me and remember those days, you know, we are regulated to that. So there are certain things that we do have control over, what we can accept and what we can't. And then there's other things that are just federal guidelines that we have to go over. Okay. As far as other sources, we talked about a few things. What if you're on a fixed income, Social Security, disability, you're on an annuity for your retirement and whatnot? Fine. All that stuff is perfectly usable, not a problem. Okay. Just be open and honest. You're going to hear me say that multiple times. You already heard me say it. Be open and honest with your loan officer. When they're asking you questions, it is not out of curiosity. It is out of necessity. Okay, so the more open and honest you are with us up front, the smoother this path is going to be to get you into that home of your dreams, right? If we're asking you questions, we're looking for detail, and you're giving us one-word answers back, that's not going to, you know, that's not going to flow real well for your whole process, and you're more likely to run into headaches down the line that maybe we would have been able to avoid if we knew up front. Okay. So when I'm talking to somebody for the first time and I'm saying, well, what are your sources of income? I make $100,000 a year. Okay, great. Where's that from? I make $100,000 a year. Okay, I got you. But you know, what is that from your job or from rental income or whatever? All you need to know is how much I make. Now qualify me. Okay, if that's all I got to work with, I will, but I don't like doing it because chances are my answer might be a lie, because I don't know I don't know all the right information I'm working with, right? So, so that comes really, really big into play there. Again, just let us know. Don't assume that something's going to be good or bad. That's the other thing. People will try to kind of hide things or slow roll us on things because they think it's gonna be an issue for us to qualify. Well, hey, wouldn't you rather find out about that on day 1 or 2 than day 30, right? So, just be open and honest with that stuff. Okay. So when we talk about capacity, one of the terms that you'll hear a lot is DTI, which stands for debt to income. Don't need to write any of that down. I'll tell you when there's only a couple things I want you to write down. I'll tell you when that time comes. So we talk about DTI. So that's how much debt you have compared to your income. DTI, debt to income. So what are we looking at? We're looking at 2 things. One is your house payment. We're talking about your new house payment. What does that include? principal, interest, taxes, insurance. And then if you're in some kind of a community, like a condominium or a gated community, you might have a homeowners association, dues, management dues, something like that. All that combined is known as your PITI, generally referred to as PITI. PITI, as you see here, because of the association dues, but principal, interest, taxes, and insurance. That's what we were looking at for your house payment. Okay. Notice there's a lot of things that I didn't mention there that go along with owning a home. I didn't mention garbage pickup. Okay. You're going to pay that monthly or every other month. Little things like electricity or oil or gas or, something to heat your home and your hot water and things like that. Okay. There are all kinds of other expenses that we don't take into account when we're doing this. This is what we're looking at. So what we call our front end ratio is based off the principal, interest, taxes, and insurance. So we talked earlier about the whole thing with the escrow and taxes and insurance. Whether you're escrowing or not, again, I recommend you do, but whether you do or not, we still have to take those taxes and insurance into account when we factor in whether this house is affordable to you, because whether we're paying them based from your money or you're paying them yourself, you're definitely going to have to pay them, right? So it's part of your house payment. So we're going to add all those together, and we're going to look at it and say, okay, this is what's affordable to you based off of your house payment. Okay, bear with me a second. Now we get into the rest of what I just talked about with debt ratios and DTI. So we have your housing ratio. That's what we just talked about, your house payment compared to your gross monthly income. Now, when I say gross monthly income, that's not for everybody. That's, again, for generally your W-2 borrowers. I should just say your usable monthly income. Okay. The important point to know here is if you are just like a regular pay stub and W-2, sometimes when we ask about your income levels, the client will give us their net, their take home. Now, for real world purposes, that is a number you should be using, because whether something's affordable to you or not, it really doesn't matter how much you make. You know, the difference between what you make and what you take home, sadly, is not the same number. There's generally a big gap there. Some people, it's more than others. If you're paying for health insurance and 401k and AFLAC and things like that coming out. So the difference between your gross and your net can be pretty big difference. We are going to go off the gross number. Okay. Now it might be averaged out over a period of time, but it's still your gross, not your net number. If you're self-employed, again, what I talked about, it's probably not the net, it's probably not the gross, it's somewhere in between. Okay. So what you're looking at there, here's an example. If you made $7,000 a month as your usable income, you see just a typical housing payment on the screen there, total payment of $2,509. We just divide the 2,509 by 7,000, and that would be 36% of your gross income going towards your house payment. I'm not making any comment whether that's good, bad, or indifferent. I'm just saying that's how the math works when we look at two things. We look at a house payment debt ratio, front ratio, and we look at a back end ratio, which we're going to get into now. So your back end ratio, what we talk about, there we go. Sorry, folks. Our back end ratio, that's the amount of your income that can be used for the house payment plus all other credit payments. Okay, that's what we call your back end ratio. And again, just a simple thing here, we have our PITI payment from the first example, plus maybe you have $250 a month in credit cards, you have a $375 car payment, your total debt there. So that would give you a back end ratio of 45. Okay. I think it was 38 on the front, 45 on the back. Is that good? That's generally accepted. Now, again, different programs are going to have a different percentage that they're looking for on that. So I can't give you just a blanket. 45 is not necessarily the max. For some programs, it is. Absolutely. We do have some programs where we can go up to 50% of the debt ratio, but I caution against that. This is more of a personal commentary than a bank standpoint on this one. If you're putting 50% of your gross pay towards your house payment or towards your debts, and again, that's gross pay, not take home, that may not be leaving you enough to do things other than eat mac and cheese for dinner every night. Okay. And nobody wants to be in that position. Yes, mac and cheese is great. We all love it. But by the third night, you're probably going to want some real protein in there. So, yeah, so our whole goal here is we don't want to set anybody up to fail. And we want to make sure we're doing realistic. So we're going to qualify you based off the guidelines and regulations for what we can qualify you on. That number may be wildly different than in real life, what you're actually comfortable with as a house payment. Okay. And that's only something you can decide. So but we're going to kind of help you to get there. So like I said, we have some programs where we might only be able to go to 40%. Some programs 45. Like I said, some programs can go as high as 50. And, sometimes there's good enough reason to do that. We've got a husband and wife, and maybe the husband is working off the books or something like that, or is self-employed and just doesn't show all their income. Hey, we're not the IRS. We're not Uncle Sam here. So we know that stuff happens. So maybe we can only qualify up to 50% of your income, but you make thousands of dollars more in real life. Okay, that's a decision for you guys to make. That's not for us. Okay. But we're going to use what we can use off of the paper that's in front of us. Now, again, I'm going to reiterate when this says on here, all other credit payments, that doesn't say all other payments, because we're not including, again, heating, electric, food, clothing, little things like that. Okay. So you need to take into account that your expenses are not all encompassing as far as what we're looking at. It's the rest of the world that you got to look at as well. All right. So with that, I am going to again turn over to Mike and see if we have any income related questions, debt ratio related questions in the chat box. Give my brother.
We do. So we have a multi-part one. What is the scale of history / stability? You mentioned months. Do years matter? What if you lived 15 years abroad?
Okay. So as far as what are we looking at, it depends on the program and depends on the situation. Like I said, if you're in a job, you've switched jobs 5 times in the last 3 years, but it's all been for the better. You were working at a fast food restaurant, and then you went to work at a chain restaurant, and then you went to work at a private restaurant, and then you went to work at a 5-star Michelin rated restaurant, 3 stars, I think is the highest. Sorry. Okay. We're seeing a progression there. You're making more and more. No problem. Now, there could be questions there if it's not stable, if you're on some kind of fluctuating hours and whatnot, that can certainly cause some headaches and some roadblocks there for us. But ultimately, we could look at that. If you're, like I said, you're just salaried, you're a teacher, we're not going to average that income over the last 2 years, because if you're getting a raise every year, why would I qualify off of income from 2 years ago that has no bearing on where you're at today? Something like that, we're going to do it based off of today's income. When we talk about self-employment, again, generally we're looking at the minimum the last year's tax return, but it could potentially be 2 years. A lot of programs do require a 2-year look back as far as that goes. So just kind of keep that in mind. Again, depends on the program, depends on what your scenario is. If you've been working abroad, that's something that, again, we got to take a look at on a case-by-case basis. Have you been filing income taxes in the area, in the US, or have you just purely been working abroad and not filing? We did have a client that we worked with in the fall who had actually played professional basketball overseas and had only been back in the States for a short period of time. We were able to do a loan for him because the job that he had here in the States was a steady job with steady income. So no problem. So again, that's one of those things where a pretty unique circumstance on that, if that's what you're looking at. So definitely want to talk to your mortgage specialist early on that one, and we can take a look at it.
Then related to this question, you kind of touched on this, but it's worth noting. Why is it that particularly self-employed people are penalized for a slow year? For example, during a period of economic decline, during which all self-employed people experience similar market forces.
Okay, so all right. So first off, I don't want to get into an argument here, but I wouldn't say that all self-employed people, maybe all self-employed people in certain industries certainly had issues. Oh, like, let's see, a pandemic, maybe. I don't know if that's what you're referring to. So yeah, believe me, this was a rough period. It was rough in a lot of ways for us in the mortgage business and a lot of businesses. If you were in something that was a face-to-face business, something like hairdressers, masseuse restaurants, things like that. Yeah, there was a lot of issues there with income. I would hesitate to use the term penalized. At the end of the day, we have to go off of what's in front of us. We can't guess at what your income should have been. Anybody that is self-employed, anybody that works on fluctuating hours or commissioned positions, things like that. And again, I've been in the mortgage business a long time. I'm not commissioned at this point, but many years in my career, I was commissioned. So I went through ups and downs and all that stuff. Again, I was in this business during the mortgage meltdown. So I went through all of that stuff. Some real lean months there. But the bottom line is we have to work off of what's in front of us. So if there is something that's going on like that, we may be able to work with you if there is a legitimate, if there's a legitimate reason. We get your 2024 tax returns and it shows that you made $100,000. We get your 2023 tax returns and you made $15,000. That's my first question. What's going on here? Did you just, go from being terrible at your job to being great at your job? Or was there outside factors that came in where were you in an accident and you were in the hospital for 3 months and you couldn't work and whatever? So we have some leeway on that, but again, that's going to shrink the box of available programs for you. And I'm not trying to be mean. I'm just being realistic with it. That's just the way that works. So there are some things that we're handcuffed by, and there are some things that we can work with, and we can work around and massage around with that. Okay.
If last year is less than the year before, even by a lot, the lesser governs. I think that might be more commentary.
Yeah, so so when we talk about taking an average of the last 2 years, it does depend on what direction you're going. If you're on a downward slide, yes, the lower we would go with the lower. We can't average a better. Okay, and just think of it in these terms. So we're in 2025. If we average the last 2 years' tax returns, 2024 and 2023, income from 2023 that's on that tax return is more than 2 years old at this point. Your income that you made between January and April of 2023 is 2 years old already. That doesn't have a lot of bearing on where you stand right now, okay? Even looking at last year's tax returns, again, income that you made from January to April, over a year old, you could be in an entirely different world, good or, for better or for worse. So we do the best that we can going by the guidelines and regulations that we have to go by. And that's where averaging out over a period of time should give us a realistic viewpoint of what you had. Like I said, you had a very good 2022, you had a really good 2023, but you had a bad 2024 because of X. Again, you were in an accident, you had whatever going on and you couldn't work for 4 months, whatever the case may be. That's something that unfortunately there's to some degree our hands are tied by that, but there are some circumstances where we'll be able to work with you and see what you should be on. And now, where are you at this year? May we look at the last 6 months of bank statements and look at how much you've been depositing over the last 6 months into your business. And maybe, you had a rough middle of the year or beginning of the year, 2024, something like that. So there are some circumstances where we can work with you on that. Okay. Anything else in there we want to talk about, Mike?
That's all for now.
Okay. All right. We're getting some good questions in here. I like it. I like it a lot. Just checking our time frame. All right. So let's go on to the next one. Third C, credit. Ooh, scary. Okay. So credit obviously has a big impact on what we can and can't do for you. Some of the things that we're going to go over some things here. So obviously your credit score does have an impact. Most of our programs do have some credit score limitations. There are some programs where the credit score itself is not taken into account. Okay. Somebody that has a 780 credit score is going to get the same exact program as somebody who has a 650 credit score. There are some programs that work that way. Other programs do not. It might be that with a lower credit score, you could be in a situation where the fees are going to be a little bit higher or the rate's going to be a little bit higher because the credit score is down. And the credit obviously higher credit score a little bit better. Or it could be a pass fail. There are programs where we have to have X as a credit score or we can't do it through there. All right. Now, when we talk about credit scores, what are we talking about? There are 3 main credit bureaus out there. When we do a mortgage, and this is not an Ulster savings thing, every lender basically in the free world does the same thing. We're going to look at all 3 of your credit reports. We're going to run one credit report with all 3 of the bureaus on there. We're going to look at your middle score. Your middle score is your qualifying score. It is not an average of the three or anything like that. It's your middle score. So it's something that you can't with certainty check yourself, unfortunately. If you have a Credit Karma or your credit cards, a lot of credit cards give you the option to get like free credit score and things like that. Those are good to see a trend. So if you check your credit score now through there, it doesn't show up as an inquiry or anything like that, and it's a 740. You had checked last month and it was a 720, and the month before that it was a 680. So your trend is on the upswing. Then when we pull your credit, we're probably going to see an upswing of that as well. But it doesn't mean we're going to see 720 when we pull it. A number of things. One, there's 3 bureaus. They have their own algorithms. Oh, and let me just put as a disclaimer on there, I hate that system, by the way, but it's what every bank uses, and I've been doing this for 30 years, and we've always had the same system. It's not fair. It's not always accurate. There's plenty of people I've seen with a high score that I would not want to lend money to personally, and there's people with a low score that I would absolutely lend to. Okay, there's weird things built into the algorithm sometimes that we're not privy to that information. We have to deal with what's in front of us. So we've got a 700, a 620, and a 610. 620 is going to be your qualifying score because it's going to be the middle score, not an average of the 3. That's the way that it works. If there's multiple borrowers on the file, this gets a little bit different. Okay, so multiple borrowers, we're going to take the middle score for each of you. The lower of the middle scores is what's going to become your qualifying score. Okay. Now, there is an exception to that. That's been the same thing since I started in this business 30 some odd years ago. About 2 years ago, there is one program where what they will do is they will average the middle scores between the 2 borrowers. So you've got a wife with a 740. I got to use an easy number here. A wife with a 700 and a husband with a 600. For that one program, your qualifying score would be a 650, which maybe is enough. Maybe it requires a 640 minimum. So that's where, again, working with your loan officer, this is what I'm trying to do. What do you have available for us? We run the credit, we look at it, and we look at those scores and say, okay, we can't do this, this, and this because of that 600 score, but we do have this program available because that one program allows us to average the 2 people's score together and move forward. Okay, so I just want to go through that. When we talk about looking at your credit score, a lot of people these days, especially because obviously there's all kinds of fraud and there's all kinds of issues out there, data breaches and all that. So a lot of people have frozen or locked bureaus. We just ask you have to get those unlocked before we run the credit. We go to run the credit, it's locked. Now we don't have any information. Now you got to call. Now there's a delay. Maybe we didn't get a hold of you the first day and there's a delay on this, delay on that. So before you apply, before you have us run the credit, we can't do it for you. I can't call up and say, hey, unlock Jane Doe's credit. Obviously, why would they? That would kind of defeat the purpose, right? So you have to do it yourself. Call all 3 bureaus, make sure they're not frozen or locked up. So when we run it, we can run it. After we run it, you want to put those freeze back on it, have at it. No harm, no foul. But we got to get that information. Okay. And then you see fraud alerts. Okay, that's something else that can come up. If there's been some type of data breach, usually you get an offer that you can put a fraud alert on your credit report. So we can do that or you can do that, you put it out there. What will happen is when we run the credit, we'll still be able to run credit, but what happens is they will go in and we're going to see there's a fraud alert. You must call this number in order to clear the fraud alert. You need to make sure that number is active. Okay, we've had situations now, there's still plenty of people that have a house phone. Obviously, a lot of people don't anymore because we all have the cell phones. But you might have had, when you put that fraud alert on, maybe you had a house phone and now you don't. We go to call that number and it's disconnected. It's not the end of the world, but it's a hurdle. Okay, now we have to use other sources to try to verify that you're you. Okay, but that's what the whole point is. So make sure if you had a fraud alert out there, make sure it's up to date. Okay, now, real meat of this, we get into your credit history. So your credit score sometimes is a reflection of the credit history that's out there. What is your payment history? Okay. How many accounts do you have that are active? What types of delinquency do you have out there? All right. All these things are going to come into play. Yes, they're going to affect your credit score, but we're also going to look at what's actually on the credit bureau. Okay. You could have a credit score of 700, but have a collection account And that collection account may need to be paid depending on the program that we're going for. It may not need to be. Generally speaking, most programs that we work with, like a medical collection, probably doesn't have to be paid. But if it's just from a credit card, it might have to be able to. Okay. Again, my favorite answer, it depends. So I wouldn't just go run out and pay it off necessarily. Although if you're in a position to, maybe you should, because that'll increase your credit score eventually. Right. So it's all tied together, but I can't tell you definitively whether you should or shouldn't. And even if you do, how much that's going to affect your credit score, we don't know until it's done. Again, the bureaus don't give us access to those types of calculations. It's just kind of a mystery. We run it through and it shows up. But we are going to look at your credit history. A lot of programs require that you have at least 3 active accounts out there for at least a year. Okay, when we're talking about especially a lot of these first-time homebuyer programs we were talking about with the grant programs and things like that, we want to see at least 3 active accounts for at least a year. So you've got a car loan, there's one. You've got a credit card, there's another. You've got a personal loan, there's another. Okay, we're good to go. Well, what if I don't have those? Should I go out and open up 3 credit cards? Probably not. Okay, that's probably not the best way to go, because now we can get into that last topic you see on there, alternative sources. So alternative sources are something that you can self-report either to the credit bureau or we can just get proof of. So a lot of programs will allow it. What does that mean? Like you're paying rent. Okay, if you're paying rent, generally that's not going to show up on your credit bureau. But if you can prove that you've been paying your rent for the last 12 months, cancel checks, Venmo, PayPal, whatever, as long as we can prove it, then that could become an alternative source. Okay, so if you only have one small credit card, but we have rent, and again, we can trace it. That's the important thing I want to make sure I highlight here. If you're paying cash to a landlord, we can't trace that. Okay, a landlord can't just give you a note that says, I promise that Jane Doe paid their rent for the last 12 months, because we don't know who your landlord is. What if it's your uncle? What if your payment history is terrible with them and they want you out? So they're going to give you a good letter to make sure that it's easier for you to get out, right? So we have to be able to prove it. It has to be tangible. So if you are in a situation where you're paying rent by cash, I'm going to suggest immediately with the next month, go ahead and start paying by some sort of traceable source. And then, now again, not every program do we have to show proof of rental payment, but there are a lot of times where we do. So we won't know that until we get in and do a full picture workup for you, right? So you're going to want to do that. Other things that could be on there, if you're paying, we all have a cell phone, right? So if you're paying your cell phone bill, that could be an alternative source. Easy. You're paying it every month. Basically, it has to be something that you're paying at least quarterly. Because I know like car insurance could be a thing, but it could be a situation where you're only paying quarterly. That's fine. Okay, any less than that, it's probably not going to count for anything. But that could be something that we could do. It could be something as simple, believe it or not, as Netflix, $15 a month. Well, if we can see that coming out of your account every month for the last 12 months, that counts as a source. So it doesn't have to be like a big thing, like a house, a rent payment or a car payment or something like that. It can be a smaller account. Obviously, if it's a bigger account, it'll hold a little more weight. That's all, but it doesn't mean it's necessarily a bad thing. We've been able to use something as small as like $10, $12 a month before. Okay, so that's alternative sources. Let's talk about delinquency. Okay, obviously, no delinquency is good, but there's different degrees of not so good when it comes to delinquency. I've had people tell me, oh, I've had all kinds of problems with my credit. I think it's going to be a problem. And they missed a credit card 18 months ago. They were late one payment on a credit card 18 months ago. It's probably not going to affect you at anything at this point. Who cares? Okay. I've had other people say, oh no, my credit's good. My credit's good. And I've got a bunch of collection accounts on there. I'm like, oh yeah, but other than those, my credit's really, really good. Okay. But we can't just yada, yada, yada collection accounts. Okay. So it's something where the more serious the delinquency is, the more impact it's going to have. Obviously, the more impact it's going to have on your credit score, the more impact it's going to have on our ability to approve you and what programs we can approve you for. And there is a hierarchy. So certainly any type of housing late is going to take the most weight because we're looking at doing a new housing payment for you. So if you have a mortgage or your rent, you've missed some payments, that's not going to look great. It doesn't mean it's going to kill the deal right away, but it's, again, these are all factors that come into play. Then I would say it would go down to like car payments, and then it goes down to like personal loans, and then it goes down to like student loans, credit cards, those types of things. So you obviously, the better your credit history is, the more likely you are to get to be approved. The higher that your credit score is, the more likely you are to get approved, and the better deal that we should be able to, the more programs open up to you, and the better deal we should be able to do for you from a cost standpoint. Okay, and obviously I hope that makes sense. Okay, you do see at the bottom of the page, this is something I do want you to jot down, annualcreditreport.com. Okay, annualcreditreport.com. I get a commission every time I say it. No, I don't, but annualcreditreport.com. That's the government-sponsored website where you can go out and get free copies of your credit report. You can get a free copy from each of the bureaus, TransUnion, Equifax, and Experian. You can go out through annualcreditreport.com. You can get a free copy of each of your credit reports. You will not get your score. Okay, so this does not impact it doesn't impact your credit score either. Okay, so going out there and getting run is not going to impact your score. This is a no harm situation. But what you can do is go out and preview what are we going to see when we pull your credit. Again, not the score, but at least the individual trade lines. So there's plenty of times in my career, any loan officer that you talk to will tell you plenty of times where somebody has said, my credit's good, shouldn't be any problems. We pull the credit and there's a missed payment or there's a collection count that they weren't aware of. Now, it could be a mistake on behalf of the creditor, and you want to go and contact them and get that straightened out. And that can take time. Okay. Don't wait until you find the house of your dreams to do this. Do it now. And now when you're ready, whether that's a week from now, things aren't going to fix themselves that quickly, but maybe you're doing this with the idea by 6 months from now, the end of the year, next year, you're going to be really, really, really looking seriously to buy your home. Do it now so that you can get in there and see what's out there. Is there anything you need to work on to resolve? Okay, that's a big thing. So annualcreditreport.com. Anything else that you go to is a private company, and I make again, the Credit Karma or some of those other things, I make no guarantees that what you see when you pull your credit through there is what we're going to see. With this, it should be extremely close. Like I said, individual creditors can update at any given time. So a Best Buy credit card maybe updates today, whatever. I was going to say Radio Shack. I know they don't exist anymore. Sorry, I'm old. But Target credit card maybe updates a week from now. So if you pull it today and we pull it a week from now, we might see slightly different stuff. But it shouldn't be anything earth-shattering on there. Okay, but again, that's supposedly does not interfere, does not have any impact on your scores. Okay. That's my general thoughts on credit. The other question everybody asks about, so I'm going to just throw it out there in case this is in the chat box already. How much, if we pull your credit, how much is that going to affect your score? I have no idea. Okay. It depends on what your situation is. There is supposedly an intelligence built in to all three of the bureaus that if you're shopping around for a mortgage or a car, when you get your credit pulled for another mortgage company or another auto loan, it's not supposed to affect your score. Okay. Here's the reasoning. Very simple. You could easily, I know I get 2 or 3 days a week, I'll get something in the mail about a credit card. I can't go out to a website without getting a pop-up about take out a credit card, whatever. So I could legitimately open up a credit card every day of the month, right? I'm probably not buying a new car every day of the month. If I was, I'd be phoning this in from an island somewhere. But so it's known that when you go shopping for a car, they're going to put your credit, your credit out to a few different loan agencies to try to get you the best deal. Same thing, mortgages. A lot of people will shop around, although I don't know why you would. You're here with Ulster Savings. Just stay with us, make everything nice and easy. But if you do decide to shop around, okay, you've already gone to somebody else by mistake maybe, and now you're coming with us. If it's within a short period of time, it is supposed to only count as one credit pull against you. Okay. I have to say supposedly and put the asterisk up there because I have no way to know. There's no way to prove it. Because the other thing is, if you went to XYZ company a week ago and they pull your credit and I go today and I pull it and I get a different number than they did, you go, oh, you told me it wasn't going to affect it. No, I told you it's not supposed to just for that credit pull. But if a creditor updated your report within the last week, then we're going off that new information. Okay, so if you missed a payment with somebody and now it shows up, but it didn't show up on the other one, we got to deal with that. Conversely, the score could easily be higher if somebody else reported and you paid something down or paid something off. Maybe the score is higher over the last week. So we have no control over that. I'm just letting you know. You can do some research on that if you like online. Very, very easy by Googling it or whatever. Asking Jeeves, whatever your source of good information is out there, you can do that, but it's not supposed to affect you negatively within, I'm going to say within a 30-day period. I know some things I read, and this is where it drives me crazy because I do a lot of research on this. Some things say it'll be within like 90 days or 60 days or whatever. I'm going to go a little more conservative and say, 3 weeks to 30 days. It's only supposed to count against you as one credit pull, but that doesn't mean the information on there isn't different because somebody didn't update, one of your creditors didn't update their accounts. Okay. With that, I'm going to turn over to Mike and see what types of questions we have out there for credit.
Got a couple of them. Can one still buy a home if they have a low credit score, but they have the funds and a cosigner?
Okay, so anybody want to guess what my answer is going to be there? It depends. We talking low 620? We talking low 480? Okay, first of all, a cosigner does not help when it comes to credit scores. Okay, with the exception of what I talked about, the one program where they'll average the two scores. Okay, if somebody's credit is bad, okay, you have 90 days late, 120 days late, you have collection accounts, non-medical collection accounts out there, you have a foreclosure or a bankruptcy within the last couple of years, your chances of being able to get that, even with somebody that's all aces, are pretty slim. We may be able to do something with that. I would never discourage anybody from applying, but just understand that box of available programs is shrinking down more and more the more serious your delinquencies are out there. So there's credit, there's assets, there's income. If you're putting a lot of money down, so your loan to value, and we're going to get into that a little bit more later, if your loan to value is lower, if we're doing 97% financing and somebody's got a 620 score and somebody else is doing 50% financing and they got a 620 score, absolutely, that 50% down, you're going to be in a much better position, much more likely to get approved. But I couldn't throw any specifics out there because we're going to look at the whole package and like I said, what are we talking about low? Some people are at 680 and they think it's low, where I wouldn't consider that low. And again, I've got other people who are, oh, my credit's pretty good, and it's in the 500s, which is low, quite frankly, sorry to say. So yeah, that's all depending on what the full package looks like. That's something, again, you just want to talk to one of our mortgage specialists very, very early, and so that we're not leading you down a bad path. Okay, or worse, you go and find the house that you want to live in for the next 20 years and then find out that maybe we can't do it for you. Okay. What else we got, Mike?
Are active accounts more important than a recent history of large loans, student loans and cars, for example?
Well, active accounts are certainly going to play more of a role than older accounts, but you kind of conflated, it seems like you kind of conflated two things on that question, because a student loan or car loan certainly could still be active. So I'm not exactly sure where you're going with that. If you have a lifetime of paying things off and closing them out, car loans, personal loans, whatever, but you don't have anything active, well, again, it depends. Is the last time you had something paid off 2 months ago, or was it 2 years ago? Okay. We have people that had a bunch of credit, even if it was perfect, but then just decided they were going to more or less live off the grid type of thing, and they have no credit for the last couple of years. When we go to run your credit, if you don't have a credit score, that doesn't kill the deal. There are circumstances where we can do a loan for somebody who doesn't have a credit score, but again, your box of available programs kind of shrinks down a little bit. So I'm not recommending you run out and open up a whole bunch of accounts, but we may need to do those alternative sources like we talked about before. The larger the account, certainly the more impact it's going to have on your score. Being perfect on a $500 credit card, but missing payments on a $40,000 car loan, those are not equal. Those are not equal things, right? There's going to be more weight put on that car loan. So I hope that answered your question, but I'm not 100% sure on that.
You got the thumbs up.
Okay, awesome.
If we are applying for a mortgage as a couple, does each person need 3 sources of credit, or is it 3 total?
So again, it depends on, some programs don't even have that as a requirement. So I don't want you thinking any of this stuff in terms of absolutes. The programs that do require it, I can think right off the top of my head, I have one that does require 3 each, and I have one that does not. It's 3 combined. So guess what? It depends. Drink. All right. So what else? Let's go one more if you have it, because we're
Do medical accounts count towards your credit?
So if by medical account, I'm assuming you mean like a collection, because there's not generally good medical accounts that we see on a credit report, unfortunately. That should be, because it's one of the big things that we have to pay for, right? And on that note, just listen, I'm not a big believer in misery loves company, but it probably almost as many people have some kind of medical collection on their credit as don't. So, don't feel too bad about that one. So like I said, most programs won't require you to pay it off, but it probably is affecting your credit score. So, we don't necessarily have to look at it as an individual thing, but if it affects your credit score and it knocks your credit score down into a lower tier, like I said, that might make it cost more in terms of your rate or your fees on a loan, or put you in a situation where your credit score is too low to qualify for certain programs. So unfortunately, we may not have to look at it, but we do have to look at the effects of it with the credit score. Maybe that's an easy way to sum that up. All right.
There's
I'm gonna
one
go on.
more if you have
Okay.
time.
Yeah, we'll give it a shot. Hopefully it's
Can you-
not 6 parts.
No, it's not. Can you share the credit report with the applicant after it's run?
Okay, so no, good question. We do get this frequently. So no, so we are not a credit reporting agency. I mean, as a bank, we do report to credit reports, but we're not a credit reporting agency. The law is very, very clear on this. Our agreements with the credit bureaus that allow us to pull credit are very, very clear. We can run it. I could show it to you on my screen, I guess, but I can't print it out for you. Absolutely not. And I'm not going to let you take screenshots, pictures of my screen either. So no, for something like that, again, I would just point you to, I'll get another little commission, annualcreditreport.com. Okay, that's your source for being able to see what's out there. If you do it within the same time frame, you should see the pretty much the same thing that we're seeing. But no, yeah, we could lose our license, our ability to pull credit on people if we hand that credit report out. Okay. If we're working with an agency, sometimes some of the housing agencies we work with, who may be able to share information with them, with your approval. Of course, we wouldn't do anything without your authorization, but we may be able to do something like that. But generally, if an agency wants to see a credit report, they're going to have to pull their own. It's just the way it is. But again, as long as they're pulling a mortgage credit report, it should only count against you as one pull. Okay, I'll get off that. All right, so let's go ahead and move on to our next topic here. These are good questions. I'm really, really happy about the participation here. Like I said, it is something I miss about those face-to-face, and we do some face-to-face still, but obviously we can get a lot more people in a room when we do it in this format. Okay, so fourth C is collateral. This is the big thing. What is it that you're buying, right? That's why we're all here. So we talk about the type of home. Now, when I say that, it's not so much about, is it a colonial? Is it a country style home? Is it a ranch? It's not so much that. It's what type of home are you buying? Is it a single family residence? Is it a multi-family residence where you want to be able to collect some rental income from it? Is it a manufactured home? Is it a new construction? What type of home are you buying? Condo, co-op, townhouse, that type of thing. So we do want to know what type of home we're working on. Different programs have different limitations depending on what type of home you're buying. So if your intention is to buy a 4-unit property where you can live in one and rent the other 3, just let your loan officer know that up front so we can go in the right direction. There's different qualifying for that. Okay. If you're interested in buying a manufactured home, or more commonly known as a mobile home, we may be able to do that. We have some programs for that. It has to be on its own land. It can't be in a park. We don't do that kind of financing. But if you're buying a home that's on a parcel of land, we have some programs that are available to do that. All right. If you're looking to buy a co-op, you're in the wrong place. We don't do co-ops. Okay. The general area where our footprint is, Dutchess, Orange, Ulster counties, in Columbia and Greene, not a lot of co-ops in that area to begin with. But it is a different animal. I'm not saying it's bad. There's plenty. I've done them in my career when I worked at other agencies, other banks. But we don't do them here. Different animal, different rules regarding them, different from a legal aspect, a lot more complicated. So we just don't do them here. We can do pretty much anything else. When we talk about residential, I talked about a multi-unit property where you're going to get rental. We're talking about 1 to 4 units. Okay, 1 to 4 units. Anything over 4 units is considered commercial property. Almost nothing I talked about tonight applies to that. So hopefully that's not the reason that you're on here. But that goes into commercial. We do have a commercial lending department here as well. We're happy to refer you over to our friends over there. But it's just 1 to 4 units. That's considered residential. Anything over 4 is considered commercial. That is not an Ulster savings thing. That's generally accepted in the free world of mortgage lending. Okay. So what type of home are you buying? That's what we're talking about. If it's a ranch or it's a colonial or it's something like that, don't really care. That does come into play when we look at the market value, which I'll get into in a moment, but not for programs. There's no program that you can buy a ranch, but not a colonial house, anything like that. Okay. Condition of the home does not have to be immaculate. Okay. If you're buying new construction, great. New construction, we have programs for that. If you're buying an existing home, it's expected there's going to be marks on the wall. There's going to be whatever, cosmetic things. If there's kids, there might be some holes in the sheetrock, whatever. But that's not going to stop us from doing our thing. When we're looking at condition, we're looking at, is it in move-in condition? Okay. Are there health and safety issues that might prevent us from wanting to lend on that home? So very simply, things like mold. Okay. That's bad. We don't want to lend on a house where there's mold and put you in a position where health and safety issues, broken windows, broken glass, missing handrails on stairs, things like that. Generally speaking, from a mortgage standpoint, it has to be something that smacks the appraiser in the face. As if I'm your loan officer or Michael's your loan officer, we're not going out and inspecting the home. We go through a third-party independent person that's an appraiser company. They go out and they do their thing. If it smacks them in the face, there's a brown stain on the ceiling. Guess what that means? There was a water problem at some point. Whether it's fixed or not, we don't know right away, but we know there was a water problem. What happens with water problems? Mold, rotten wood, okay? Could be infestations. Okay, these are things that we're going to make sure if the appraiser notes them, we're going to bring them up. And now it's part of your negotiation with the seller. Okay, so we are going to have an appraisal done on almost all of our loans. There's going to be a full appraisal that's done. An appraisal and an inspection are 2 different things. So I'm going to go off on a little bit of a tangent here. Okay, most of our programs do not require an inspection. We do have one program that does. Most of our programs do not. Okay. The inspection is different than appraisal. When you do an inspection, and I encourage everybody to do an inspection. I don't care how well you know, and unless you are an inspector, you should be hiring somebody to do an inspection. An appraiser goes out to the house, might spend 10 minutes there. They're basically, most of their work is done back in their office. They're going out, they're snapping a couple pictures. They're looking around, seeing if anything smacks them in the face as far as work that needs to be done. Okay. If not, they're out of there. You are hiring an inspector to go out and you are paying that person to find out everything that's wrong with the house now and what might go wrong in the very near future. Now, they don't have a crystal ball, but if they're there and they're looking at your boiler and the boiler in the house and the boiler's all rusted and rotted out and it's dripping and something like that, they go, okay, well, it's functional. You have hot water, you have heat, but in the very near future, you're looking at $7,000, $5,000 repair, something like that. Don't you want to know about that before you go and put $200,000, $300,000, $400,000 down on a house, right? So you're paying that person to find out everything that's wrong now and what might be wrong in the near future. Okay, even if the house is relatively new, I think you still want an inspector, a qualified inspector, to go out, because what if it wasn't built correctly? Okay, you want to know, what if something wasn't built quite up to code? You want to know those things. So make sure that you're doing that. We, for overwhelming majority of our programs, we do not require that. We don't want to see it either. If you have one done, that's between you and the inspector and the seller, because you can use that as a tool to negotiate some things with the seller. Maybe they're going to get some stuff fixed. Maybe they're going to lower the price if there's work that needs to be done instead of getting it fixed. If it's not a health or safety issue and it's more of an aesthetic thing, a cosmetic thing, you can work that out. Like, you know, one of the rooms has torn wallpaper all over it. Well, you don't necessarily want the seller to fix it, because what colors and what, you know, what's going to go up there, all that stuff, but you should get compensated for that for when you go to fix it, either hiring somebody to do it or whatever. So maybe that instead of being 300,000, maybe it's 298 or whatever. So there's some negotiating power there. If it's a health and safety issue, that generally has to be done before closing. Okay, there are some instances where we can do something called an escrow holdback. I don't want to get into great detail here, because most people, this doesn't come into play. That's something you can talk to your individual loan officer about. But there is some instances where we can do something where, say, okay, there is mold on a house, or there's radon gas, it fails a radon gas test, and you got to put in a system to cure that. That might cost $2,000, $2,500, something like that. So the seller's going to give you a credit for that. Well, if we see it in the contract, now we need to see that it's fixed. Okay, so that's something, again, you're going to want to talk to your loan officer about before you go and do your full negotiating and get contracts drawn up. All right. So, but that's basically what we're looking at, is what type of home it is, single family, multi-unit, condo, those types of things. What condition is the house in? Anything that's a health or safety issue, we want to, you know, we want to make sure we address. And then fair market value. That's when the appraiser goes out and does their thing. It's one of the things that I've been doing this over 30 years, drives me crazy in this business. Somebody will say, your appraiser misvalued my house. My house should be worth way more than what your appraiser said. Well, it's not my appraiser. Yes, as a company, Ulster Savings, we are going to hire the appraiser to go out and do it. There's no getting around that. But they don't work for us. They are an independent third-party company. They are doing their thing. They are submitting a report to us. We do look at it. We have a separate appraisal department that's going to go through and look at it, make sure that it's accurate in terms of bedroom count, bathroom count, things like that, square footage. We're going to look at the county records and make sure it's accurate. As far as the value itself goes, a lot of that is opinion. So one person might love a pink house with purple polka dots on it. Somebody else might go, well, I'm going to have to redo the entire outside, so that house should be worth $20,000 less than an equivalent house on it. So that's going to come into play when we talk about fair market value. Something's value, when from a housing standpoint, is not what one person would pay for it. It's what the general person would pay for it. Okay, and that's important. If you go and you look at a farm style house, a barn style house, but the next, and you love it because you love that aspect of it, but somebody else doesn't, they're not going to pay the same price. So we can't narrow it down to what one person thinks is valuable. We have to do what the general population thinks the valuation is, and that's what the appraiser is going to do in their report. Okay. Some of the things are tangible: 3 bedrooms, 2 baths, 2,000 square foot. Other things are opinion: colors of the house, design. Is it an open floor design? Is it so there is some flavoring that the appraiser will put into their value, where another appraiser may come up with a slightly different value, but generally it's not going to be night and day. Okay, could 2 appraisers be $5,000 off, $10,000 any day of the week? Easy. But generally that doesn't happen. A lot of time, most of the time, the appraiser knows what the sales price is when they go into it. So they're generally going to try to hit it within reason. If they don't think it's worth it, don't you want to know that? You put in a bid for $280,000 and the house is generally only going to be valued at $250,000. Don't you think that's something you would want to know? So that's where that comes into play. So, all right, Mike, what do we got going on? Oh, I got to unmute you here. What do you got going on in the chat room while I give my voice a little break?
What if the seller is a bank and the house is being sold as is?
Okay, we run into this. Yeah, and it doesn't just have to be a bank. Any seller can decide to say, I am selling this house as is. Good luck to you. So that's something that you have to take into account when you're looking at buying the house. Some of those houses, depending on the condition, my favorite word again, depends, depending on the condition, that might be a cash sale only. Okay, it may not be financeable. That is a possibility. Another possibility is that we might need to do what we call a rehabilitation loan, or commonly referred to as a rehab loan. We can get you money to buy a house and funds to fix it up. Those exist. More complicated, okay? Other qualifications come into play with that. We have to be able to get estimates and all that up front. So the seller has to play ball with you on maybe letting a contractor into the house multiple times to make sure we're getting good estimates and things like that. But that is a possibility. But if the seller wants to sell the house as is, and there's something that shows up on the appraisal that we don't like, now it's a negotiating tool. The seller can say, too bad, I'm not doing anything. Now, it could be them just being difficult, but it could be a situation they don't have any money to do anything. You know, that is a situation that we run into. So it's not that they're necessarily being a bad person. It's just a situation where they don't have any money to fix it up. You know, it's an estate sale, and the person didn't have any money in the estate, so they're selling it as is. Maybe it's got to be a cash sale, maybe it's got to be a rehab loan. Generally, things like that will be stated somehow in the listing. You go online and you look, and it says, you know, the old needs some TLC, needs a little needs some care, needs a little polishing up. Those are what we call tells in the business, that there's probably something going on there that needs to be looked at a little more. What we're going to do, what I have my team do, you give us an address, we're going out online and we're going to look at the pictures online also. Okay, so it's your responsibility to do it. I'm always going to do that as well. So I go out and I look at the pictures. If it's not a listed property and it's a private for sale by owner, I'm not going to be able to be much help to you on that, because I'm probably not going to be able to see any pictures. But if it's one that's listed and there's 8, 10, 12 pictures of the house online, I'm going to look at those and I'm going to go, hey, look at the third picture in the kitchen. That looks like a brown stain on the ceiling. You need to find out what's going on there. Okay, so I'm giving you this information now, that's something you can do. We're going to be there in a lot of cases to try to help you with that, but don't rely on us to do it, because we have much more limited information. You're generally going to the house, walking through it, what have you. So you've got a lot more, firsthand experience with that. All right, but that is definitely it is a situation we run into where some sellers will not budge, whether it's a bank or whatnot. We did have one recently that was like that. I can tell you, our buyers were kind of put through the ringer by the seller, not by us. We were working with them. We were trying to get it done. But the seller had done a bunch of repairs to the house and had never gotten permits for it. And so when the title report came in, there was a discrepancy there. We couldn't get clear title because the town wasn't gonna allow it. So, and the seller didn't want to let the town into the house. Well, we can't do anything with that. That's between you. Ultimately, it wound up getting worked out and everything was fine, but they put the buyers through the ringer on it. So that is a buyer beware situation. If you see some of those comments in the listing about, like I said, polishing up, TLC, handyman special. That's another one of those old terms you might see once in a while. All right, what else we got there, Mike?
If an appraisal comes back more or less than the house is listed, how does that affect the price of the house?
Okay, so the appraisal is between us and you, period, end. Okay, if the appraisal comes in high, you do not tell anybody else, not your own realtor, not your own attorney. You just don't need to do it. Good for you, great for you in some cases. Okay, you already are going to have some equity built into the house that you weren't expecting. Fantastic. You do not need to tell anybody that. That is not of public record. The assessed value for a house is public record. Anybody can look that up. Property taxes are public record. You can look that up on any house. But the appraisal, you paid for it, we see it, you see it, that's it. If it comes in low, now we may have a situation. You might be able to do some negotiating with the seller. You agreed to a price of 300. It came in at 280. We are going to use the lower of the sales price or the appraised value in order for us to calculate anything. So if we say we're doing 90% financing and the house comes in at 280 instead of 300, we're only going to finance 90% of 280, even though your sales price is 300. So what are your options there? You can pay the extra money if you have it and you want to, okay? Because both of those things have to be true. You have to both have the money and be able to. You can go back to the seller and say, hey, we need to renegotiate this. You know, the value is not there. The seller's probably going to say, we think it's a bad appraisal because obviously they think the house is worth more. Now, at that point, now you have a decision to make. You can now share that appraisal with the seller. That's probably what you're going to have to do to get them to negotiate. Are they going to take your word for it that the house came in low? Probably not. So they're going to go ahead and ask you for proof. So you can send it. We're not going to do that, but you can send it to them. You'll have it in your email. And I think we still mail a hard copy, but you can email them over and now you can negotiate with them. They have a decision to make. Do they want to negotiate? Do they not want to negotiate? Do they want to come in somewhere in between, or will they go all the way down to whatever the appraisal was? So that, you know, there is a bunch of kind of if this, then that comes into play with that. It is something that we run into, unfortunately, from time to time. And it really just depends on what the scenario is between what's the relationship between you and the seller. What is the seller capable of doing? Again, is it a situation where they owe 290,000 on the house, so they need to sell it for 300 in order to even come close to breaking even with the realtor fees and whatnot? So they may or may not have some room to wiggle with there as well. But that is a case by case situation. Comes in higher, great, move on.
Is the appraisal value what taxes are based off of or something else?
Nope. No, that, like I said, the appraisal is not public knowledge. So that's just between you and us. The town will go out and do their own assessment. They don't have the appraisal to work off of. Sales are a public record, so they will know what the house sold for. So, but generally there's some kind of discount that most municipalities will give when they do their assessed value. All right. And we are definitely running short on time here. So I'm going to call it quits on that. I got just a few more things I want to go over with you guys, and we'll see about doing some at the end. So I want to talk about getting pre-qualified by Ulster Savings. It should be your first step in home ownership. I've said it a couple of times. Don't go find the house of your dreams only to, you know, get your dreams crushed where we can't qualify for that house. Okay. Get pre-qualified first so you know how much that you have to work with there. You'll find out what your buying power is. What are you pre-qualified for on a loan amount? What are you pre-qualified for on a monthly payment? Okay. What are your down payment requirements? Like we talked about up front, it depends on what program we're going for. It might dictate how much you need to put down. What is your new monthly payment going to be? We're going to look at not just the mortgage payment, but the taxes and the insurance and the HOA dues. So we're going to look at all, if they exist, we're going to look at that and say, okay, I've had many, many times in my career where I've gone through and pre-qualified somebody. If they just came in, they didn't have a house of mine. They just said, tell me what I can qualify for. And I go, well, based on the numbers I have in front of me, you can afford a $400,000 house with a $3,500 a month payment. And the person has looked at me and go, oh my God, there's no way I could afford that much of a payment. Remember, there's all those other bills that you have that we're not taking into account: food, clothing, electric, oil, gas, you know, whatever. So that's a decision you have to make. You asked me to find out what the most is that you qualify for. That's what I'm going to give you. That doesn't mean I'm telling you should run out and buy a house for that. Okay. We do have an online pre-qualification process. Even if you talk to a loan officer, a lot of people like to just be able to just say, we'll give you directions out on ulstersavings.com. You can go onto our website and do the pre-qualification process on there, and then it'll get assigned to your loan officer. You have the option to pick somebody or just go in round robin if you haven't found somebody ahead of time. So that is a thing. I do want to make mention, as you see at the bottom in big bold letters here, pre-qualification is not a commitment to lend. A pre-qualification is not a commitment to lend. Same thing. Some companies call it a pre-qualification like we do. Some companies call it a pre-approval. It's basically the same thing. That's not a commitment to lend. Why not? Because life happens. Okay. So we pre-qualify you today. You're good. Go out and find, you can afford a house up to $350,000. Great. You go out and it takes you a month, 2 months, 3 months to find that house. You go out and you find that house and say, okay, I'm ready to go now. And you haven't been in communication with us in between. Well, now we go to run your credit and your credit is a lot worse than it was when we ran it 3 months ago. Or you had to, you changed jobs and you took a job that is paying you less or is more fluctuating. You had a job that was steady. Now it's fluctuating. So we don't have the same income to qualify you off of, right? There's life things that can happen. So we can't guarantee you from pre-qualification that you're going to be able to close because there's all those little things that are outside of our control. You know, if everything comes in with what we told you, you're going to be able to close. But if something has changed, either with our, it could even be environmental, okay? Rates go up 4%. So now we're in a whole different world. God forbid that happens. We're in a whole different world in terms of qualifying, right? So those are things that are outside of our control. What we can control, we will, and we'll make sure that everything is up to speed. Okay. Okay. What type of documentation do you need? You don't need to write this down. It's all pretty basic. We need income. We need assets. We'll take care of the credit stuff unless you don't have enough credit lines, then we may ask you for additional things, right? But what are we looking for generally? Most recent pay stub or two. I need to amend this. I would always ask for, if you have any type of fluctuating pay, bonus, overtime, fluctuating hours, commissions, anything like that. We also want your last pay stub from last year, okay, because that gives us the breakdown. Well, doesn't my W-2 give you all that information? That gives us the lump sum, but it doesn't give us the breakdown. How much was base pay? How much was overtime? How much was commission? That's on some companies, it's not even on the pay stub, but generally it's on that pay stub. So the last pay stub from last year, along with 2 years W-2s and recent pay stubs, that's what we want. Some programs don't require tax returns at all. Other programs might require 2 years. Other programs might require 3 years. So just be prepared for all that. If you're on fixed income, we want the award letters for those. Other income sources you might have, child support, alimony, whatever. If you do disclose that to us, we just need the proof of that kind of thing as well. Okay, so that's where I have to put kind of a broad statement out of others. All right. When it comes to assets, we're generally looking at 2 months, or if it's a quarterly statement, you get 2 months, or a quarterly statement is really what we're looking for. On that, I'm just going to say, when it comes to assets, if you have cash, and I mean cash, like in a coffee can underneath your mattress, we used to call it mattress money back in the old days, or just in a cabinet or something, that's going to create a big hurdle. We have to be able to source all funds going into your transaction. So if you have cash and you're not readily about to go put an offer in on a house, maybe you're going to look in 3 months, 6 months, whatever, get it in the bank now. We are going to look for, as you see, the last 2 months of bank statements generally. So if you put it in today, 61 days from now, we can get a printout of your last 60 days and it's as though it was there forever. We don't know. But if you put it in today and you apply tomorrow, we're going to see it. Well, where did this $15,000 deposit come from? Oh, I had cash in my house. It's great that you have it, but we can't count it for your transaction. Okay, we have to be able to do it. Maybe it can be a situation where you work out a gift with somebody for it, but generally speaking, if you do have cash, you want to get that deposited ASAP. Okay. Other items needed based on your circumstances. Again, I just got to throw that out there. There's no way this list would be 18 pages long for me to try to cover every scenario that's out there, all the documentation that might be needed. Okay. Just some types of loans that we have. You got your regular plain old fixed loans. We've got adjustable loans. That's where generally it might be fixed for a certain period of time, 5 years, 7 years, 10 years, something like that. Generally has a lower starting rate. but it's the risk that once it adjusts, it could go up or down from there. Okay. It's not right. It's not good or bad. It's just situational, whether it's right for you. Construction and renovation mortgages, we didn't get into too much detail because that's a smaller population that's interested in that. If you're interested in that type of thing, please talk to one of our loan officers like Mike about that. We have some great programs for those things. Conforming mortgages, that means it's basically it goes by the general guidelines. You hear the terms like Fannie Mae, Freddie Mac. That means it's a conforming mortgage. So there's one set of guidelines for those, or they each have their own set of guidelines, but one basic set of guidelines for that. Then you have a jumbo mortgage. That's anything over, generally speaking, it's about anything over 800,000 or so would be a jumbo mortgage. There's some different guidelines with that. We're probably not doing 97% financing. We're probably not going to be able to get you any grants for loans like that. Again, that's a different category. Government insured loans, you're talking about like FHA, VA loans, things like that. We offer those here as well. And then land mortgages. You want to buy a piece of land that you're going to build on in a year, 2 years, whatever. We do those as well. A lot of banks don't do them. We do land loans as well. So that is a thing. Okay. Again, terms are totally different. We're not doing a 97% financing on a raw piece of land. So just keep that in mind. All right. Who are you going to deal with throughout your process? Your first step is either me or a loan officer, loan consultant, mortgage specialist. I've used those terms interchangeably during this process. All means the same thing. Okay. Senior loan officer might sometimes, I've seen some places where they have senior loan officer. Some places it's the only loan officer they have, so they're naturally senior. Sometimes it means the person's older. Sometimes it means that they have actually, accomplished more in their career. We don't really do that here. So loan officer, loan consultant, mortgage specialist, all the same. That's like Mike's position, and he's ready to talk to you. Your loan processor is your next step. That's once the application is finished and we have all the documentation, you have the house, you have a signed contract, file moves to your loan processor. They're going to look at that stuff. There's other other things that they do with the file, some checks and balances, things that go on there. They would be in touch with it. Then it goes to underwriter. They're the ones that actually say, yes, we're approved. And then it goes to your closing coordinator. They're the ones that have the fun job of coordinating the actual closing. It's right in the name of getting everybody together. You, the seller, your realtor, the seller's realtor, your attorney, the seller's attorney, all these people, they have to work with all of them to get everybody together. It's not necessarily in the same room at the same time. The seller can sign their stuff ahead of time. Sometimes we still see the old fashioned everybody around a big table with the keys being slid across, but sometimes it's a little anticlimactic sometimes when the seller's not there and just their attorney is just going to give you the keys or the code to the garage door, whatever the case may be. Okay, so just some real quick do's and don'ts. Make sure you have access to your pay stubs, your bank statements, all that stuff. Nowadays, almost everybody can get that stuff online, so it's very easy. But if you work for a company where you can't get them online, just make sure you're starting to save them so that when the time comes when you are ready to apply, you don't have to wait 3 weeks or a month to have 2 pay stubs or something like that. Like I said, end of year pay stub, you want to get a hold of that as soon as you can. Keep copies. Anything you give to us, just keep copies. Everything gets turned into digital, obviously, in this day and age. I'm old where we had old thick files filled up. Nowadays, it's all digital. We have a computer crash and we lose some information that way. You want to keep copies of the stuff that you have. Make sure you're paying your debts on time, all that stuff. Don't co-sign a loan for somebody else if you're interested in buying a house anytime soon. The term co-signer, I hate. It drives me crazy. You are not a co-signer. You are a signer. Okay, it matters just as much for you as it does for the person who you are co-signing. So your nephew wants to buy a car, asks you to co-sign on the loan form. Guess what? That $500 payment, we have to count it against you as well. There are some times where we can take it out, but there's more work involved. We have to prove that your nephew's the one that's been making the payments for at least a year. So if you co-sign a loan 6 months ago, we got to count that $500 against you. Okay? Be aware of that type of thing. And just make sure you reach out to your loan officer as soon as you find a house that you're interested in so we can go through and re-qualify you. And make sure if there is any major financial decisions that you make, run them by your loan officer. I'm not saying you have to check with them first, but understand it might affect your ability to qualify. I'm going to give you an example because this just came up last week. Somebody that was in the middle of processing with us with a loan quit their job. They decided they were going to become a day trader. Okay. They just decided to become a day trader. We have no history of them making income that way. Their income went from $70,000 a year to zero qualifying income. You don't want to be in that position when you found your dream home. Okay, so just be aware of that type of thing. When you have something like that coming up, maybe reach out to your loan officer, run it by him, just say, hey, how is this going to affect us? Okay, and then you can make your decision from there. All right. General steps, we've kind of gone through all this stuff already. I'm not going to read this to you, but basically gather your information, talk to your loan officer, do your application for your pre-qualification, find your home, get more documentation, put everything else in, close on your house. Okay. It's that easy, right? It's that easy. That's smooth. That's simple. Okay. And that's basically it. And the last thing I want to put on that is, this is a stressful process. There is no way around that. It should be. You're putting your money and your time and your effort and your emotions on the line to buy a place that you are planning on living in for X number of years. That should be stressful to a degree. Our job here at Ulster Savings, what we do very, very well, I'll say better than anybody, we reduce that stress level down and make it manageable. That's what I've been saying for 30, maybe not 30 years, because I didn't come up with this right the first day I started, but for a couple of decades, I've been going over this to people. My goal is not to eliminate the stress in this process. It is to minimize it for you. Okay. I'm going to make sure you are as well prepared as possible. I'm going to let you know when I see there's going to be some hurdles to overcome. I want to do those as early in the process as possible, not spring something on you at the end. Okay. So keep that in mind. And I know we're over time already here. Sorry about that, folks. But you want to get your $750 homebuyer credit certificate? You see it on the screen here. Okay, we're going to ask you to email the code word sunshine to dreamshappen@ulstersavings.com. That's dreamshappen@ulstersavings.com. Okay, you're going to send an email to there, code word sunshine. It can be in the, wow, blanking out. It's been a long night. In the subject line, it can be in the subject line. It can be in the body. It doesn't matter. But I want to see that code word sunshine. I'm going to ask you another thing. Give us some feedback. What did you think of the presentation? Okay, we make changes to these from time to time. Please be gentle. I do have a delicate ego here, but no, let us know. What did you like? What did you not like? Okay. I have my corny jokes. I try to keep you entertained. I try to keep you interested in the whole thing as we go along here, right? So let us know what you liked, what you didn't like. You have any questions or comments for Carolyn and for Ulster Habitat, feel free to shoot them to me if you didn't get her contact info, and I'll make sure that you get hooked up with her. Anything for us, obviously, you can put in there. Any questions we did not get to, go ahead and shoot that in that same email. One email is fine. Those come to a shared mailbox that I review. Getting you your certificate, please, please, please listen to this, okay? Getting you your certificate, that is a manual process. It is not just me hitting a button and it goes out to you. So give us about a week. All right, so today's Thursday. Give us through next Thursday or so before you start, reaching out. Hey, as you attended, I requested, I didn't get it. And check your spam or your junk email boxes. Sometimes they get locked up in there. So I'm just going to ask you to look at that. It does come from Ulster Savings. It doesn't come from me. It doesn't come from Mike. It comes from Ulster Savings mailbox. So just as long as you have that open on your computer, we should be fine. But give us until like next Thursday. I'm just going to go ahead and say next Thursday, Friday. If you haven't received it by then, go ahead and email us again at Dreams Happen, and we'll make sure that it gets out to you. But that's it. Go ahead and email us that. We're going to get that out to you. With that, I've got maybe another question or two left in my vocal cords at this point. So. Mike, anything else new and exciting in there that you want to go over, and we'll let everybody go that wants to go?
There's quite a few, but I'll try to hit some of the quick ones. How long is this program good for? I'm assuming they mean the certificate.
The certificate, we generally would put them out about 2 years. So the certificates that you're going to get are going to say they're good through December 31st of 2026. Okay. And quite frankly, if it takes a little longer than that, just reach out to us and we'll probably just honor it anyway. But yeah, so December of 2026. I should have mentioned that. Good call.
How long are pre-qualifications guaranteed for?
Okay, so first off, not guaranteed. I think we covered that. I think somebody might be playing with me by asking it that way.
That came in before.
Okay. Okay. So favorite answer, it depends. So your pre-qualification, it's anything in the file has an expiration date. I mean, your W-2s are good for the year, obviously, that type of thing, tax returns for the year. But anything else, your bank statements, your credit report, your pay stubs, they're good for a period of time, 90 days, 120 days generally, something like that. So your pre-qual certificate is good up until the oldest thing expires, essentially. So if we run your credit today, but because we haven't gotten documentation from you or whatever, you're going on vacation, it takes you a while to get back to us. So we can't issue the pre-qualification for 3 weeks. It's going to be 120 days that the credit is good for minus that 3 weeks because we've already run your credit 3 weeks ago. So whatever the oldest document is, that's kind of where it goes to. But all it means is that it doesn't mean we have to close out the file and start over. It just means that we have to rerun the credit or get new pay stubs or get a new bank statement. That's all. So that's low stress. Don't stress about that. Right. Go a couple more if you're okay, Mike.
Yeah. Does Ulster Savings offer financing on foreclosures?
So sure. We don't treat a foreclosure any different than any other house. The big thing that we look at there is was the title transferred cleanly from the old owner to the bank or to the company that bought it from the bank or whatever, and then B, what is the condition of that house? My experience with the foreclosures is very often those houses have gotten damage either just from neglect or willful damage of somebody being mad that they had to give up their house, or I've even haven't seen this in a long time, where people started breaking up the sheetrock in the house to take like the copper piping out for the plumbing because they could sell that for scrap metal and stuff like that. So it's more going back to when we talked about the collateral and talked about what condition is the house in. Obviously, if somebody took the boiler out to sell it for scrap metal, it's got to have heat. So that's something that you're going to have to work on. Maybe it has to be a renovation loan. That type of thing, which again, we do those. But the fact that it's a foreclosure itself is almost a non-factor. Okay. And let's go one more.
Yeah, when does the appraisal occur in the transactional process of the sale?
Okay, so you sign your contract. You've already been pre-qualified at this point. Once you sign your contract and we have all the documentation we need and we forward it off into processing, we're looking to do the appraisal right then and there. We want to get it done early. The appraisal and the title are two things that are outside of our control. Okay, so we're going to order the appraisal. It might take, in this environment, I don't know, Mike, is a week or so for the appraisal to get out there, generally within a week, something like that, right?
I've been seeing it recently. It's been a week, but it really depends on the appraiser's volume.
Yeah.
They're generally allowed 2 weeks, but
yeah,
most cases between a week and 2 weeks.
Yeah, hopefully they can get out there between a week and 2 weeks, and then they have to complete their report, which might take another week or two. Okay, so we want to get that ordered as early as possible. Now, different banks may do this different ways. We collect for the appraisal. You're going to have to pay us for the appraisal. It's a flat fee. And it depends on what we're appraising. A condo might be different than a single family, might be different than a 3-unit. So, bear with me in there. But we're going to have we don't have you pay an upfront application fee or anything like that. Some banks might make you do that. We don't do an application fee. We only have you pay for the appraisal upfront, and that's just what it costs us. There's no markup on it. So it's not like we're charging you $600 and we're paying the appraiser $400. That it doesn't work that way. It's dollar per dollar exactly what it costs us is what it'll cost you. So we're looking to get that done up front because, again, A, it takes time to do. B, it's outside of our control. So if it is going to come in light, if there is going to be any health or safety issues that need to be noted on it, we want to know that as soon as you don't want to wait until you're clear to close otherwise for something like that to happen. All right. And with that, anything that's in the chat box, we're going to go through it tomorrow. Possibly next week because tomorrow's already Friday. So we'll go through the questions that are in the chat box that we didn't get to. We'll make sure that we reach out to you with answers and or let me know if you want to be set up with a loan officer if you're not working with somebody already. If you are working with somebody already, you can put that in your email as well. Should have said that up front. If you're not working with somebody and you want to be, you can let me know that as well, and I'll get you assigned to somebody and make sure that they can answer all the questions that you have and hopefully get you on your path to homeownership. And with that, I thank you very much for your time. I know everybody's time is valuable. The fact that you took a couple hours out of your life to spend with us does mean a lot to us. We do appreciate it. And, we love doing these things, these types of presentations with you. We had a lot of great questions tonight. Really appreciate the back and forth on that. And like I said, we will get to the rest of the questions, but I'm running out of gas. So thanks, folks. And hopefully we will be seeing you on your way to your closing. All right. Take care. Thank you. Have a great night. Thank you, Michael.